You no longer have to compromise on managing your private wealth. Now you don't have to choose between growing your portfolio or shrinking its carbon footprint. You can do both. You don't have to choose between enriching your own life or ensuring your family's future. You can do both. Or between the trusted service of a local firm and the global access of a multinational. You can have both. Because LGT Crestone gives Australian private wealth investors the best of both worlds. Visit lgtcrestone.com.au.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here at ausbiz. Let's check where we finished last week. A bit of a mixed end for global equity markets, with bond yields rising despite little data. On Wall Street, the Dow closed above the 40,000 mark for the first time, taking its gain for the week to 1.2%, its fifth consecutive weekly gain. The Nasdaq climbed more than 2% for the week, and the S&P put on more than 1.5%. And in fact, all 11 S&P 500 sectors are currently above their 200-day moving averages. Stocks specifically, Advanced Micro Devices gained after Microsoft said it plans to offer its cloud computing customers a platform of AMD artificial intelligence chips that will compete with components made by NVIDIA. NVIDIA shares fell ahead of its highly anticipated earnings results this week. Reddit shares surged following a partnership with OpenAI to bring its content to ChatGPT. GameStop continued to plummet after the video game retailer said it would sell up to 45 million shares, taking advantage of the meme stock frenzy this week, while it expects first quarter net sales to drop from a year ago. Energy stocks rose on hopes of firmer demand in both the US and China, and the gold miners rose on expectations of interest rate cuts. Well, in the US, the Conference Board leading index for April fell 0.6%, more than the 0.3% fall that had been forecast. And Federal Reserve member Michelle Bowman has said, with average core consumer price index running at an annualised rate of 4.3%, she said, my baseline outlook continues to be that inflation will decline further, with the policy rate held steady. But I still see a number of upside inflation risks that affect my outlook. Well, US Treasury yields rose ahead of the Federal Reserve minutes, which are due this week, which may offer new insights into the timing of rate cuts. The 10-year yield was at 4.42% and the 2-year rising to 4.82%. Eurozone consumer inflation data has come in at 2.4% year on year in April, in line with forecasts. The European Central Bank has laid out the case for a rate cut next month, with discussion now shifting to what conditions must be met for more easing. And the euro edged higher against the dollar, with the greenback lower against most majors, the Aussie trading at 67 US cents. All right, well, let's get across those macro moves, how it's influencing investment decisions. Chad Padowitz joining us from Talaria Capital. Chad, good to catch up with you again. What are you seeing?
Good morning, Andrew.
What are you seeing out of the States at the moment with those the latest data, macro data that has come our way? What are you actually making of the state of the US economy at the moment?
Yeah, look, we've definitely seeing some disinflationary trends coming from wage inflation and discretionary spending, but there's also non-discretionary inflation that's keeping things up. So you are getting somewhat sticky inflation, but I think broadly coming down, which will support interest rates cuts into the future. However, you do have a weakening economy, broadly speaking. We are seeing that we are seeing that broadly across the board. We're seeing credit card delinquencies going up. So you have a somewhat challenging economic backdrop that I think will continue to play out as the year unfolds.
What are you seeing in particular with the labour market? Because that appears to hold the key, does it not?
Absolutely. Look, wage income obviously drives a substantial amount of consumer spending, which drives the economy in the US, and basically most Western world economies are driven by consumer spending. So wages are supported by still relatively high nominal inflation as well as a relatively tight labour market. So the labour market is getting weaker, as in less people are quitting. So people quit when they think they can easily find a job. There's less of that going on. So that is one indication. You haven't really seen mass layoffs yet. So we're still in that period of time where things are weakening, but certainly not to the extent where unemployment's going up in a significant way, which is keeping the US economy sort of relatively on track, I suppose.
Do you think that's likely to come, though? I mean, I guess we talk about that hard or soft landing or no landing, as to whether we will start to see job layoffs, and obviously how that impacts the consumer. Obviously, they don't have a job, that cuts their spending, and the effect that will have on earnings.
Absolutely. Look, there is always quite a long lag time between higher interest rates and a weakening economic environment. And by weakening, we effectively mean unemployment to go up. So I think that is still very much the playbook in action right now. We are seeing, as I said, the early stages of a weakening employment environment. And the fact that interest rates haven't, not yet dropping and probably not dropping immediately. So we're still in an environment of elevated and historically higher interest rates. So I think we should expect the pathway for unemployment to continue to move upwards, as well as you mentioned, consumer spending and the economy to react negatively from that.
Now, of course, Chad, global markets at or near record highs at the moment. All of that clearly on that optimism about rate cuts that are coming. Historically, what actually happens in that process where we head in towards the easing cycle?
Yep. So look, equity markets tend to peak in that period where interest rates are flat, as in pause. And the reason for that is quite intuitive, is you raise interest rates to slow down the economy. When you're starting to see that happen, you stop raising rates. And so that's where we are at the moment. So you tend to have the peak around the period we're in now, where you've paused. And earnings per share tend to decline before the economy actually weakens, or before interest rates actually start coming down. So the idea that interest rates will drop generally happens in an environment of a weakening economy, weakening earnings, and weakening share prices. They tend to only help the economy sometime later, like about 18 months after they start dropping. So one should, from a historical perspective, one should not be getting any comfort that the outlook for interest rates dropping are coming, because that's not historically a time to be owning equities.
So, Chad, all that said, then, where are you looking for opportunity at the moment?
Yeah, because we believe the economic environment continues to deteriorate and valuations are at very high levels, as in there's a disconnect between the economic environment and what's happening at the equity market. We're looking for companies that are less economically sensitive. As an example, I'll just give one example. There's a German European-based specialty chemical and chemical distributor called Brenntag, which we think is a very good company that's come down because demand's dropped somewhat. But you're able to buy a company like that that's asset light, that doesn't really have any significant exposure to the economy, because it's just a pass-through business. It doesn't have a lot of fixed assets. It doesn't have much operational financial leverage. And you can buy a company like that benefits from making acquisitions and to consolidate its industry with its cash flow. So, those are the sort of businesses on 8-9% free cash flow that we like.
All right, so you're pointing out there with Brenntag limited balance sheet risk, so you're seeing plenty of upside there.
Yeah, we think it's trading around 68 euros. On our bottom-up work on normalized earnings, we think you get around about 100 euros.
All right. So have you then are you focusing in particular on Europe at the moment? And I guess, particularly, also as the ECB likely to be one of the first major central banks to move? Yeah,
well, look, we have in our portfolio, we have in the mid 20% European exposure, but that's not really a function of our view on the economy, which we expect to continue to be relatively weak. it's rather because a lot of the companies that we do like happen to be based there. Some of the European pharmaceutical businesses which we like are actually global businesses. So that really drives some of that exposure. And also the valuations in Europe, listed equities are a lot more attractive than the US. So that's why we're seeing more opportunities there.
All right, beyond Europe, what are you thinking about Asia at the moment, and in particular China? Given we're seeing a little more positive data there, but also with more stimulus to come.
Yeah, look, China's going through what we think is broadly a long-term structural lower growth environment due to high levels of debt, a less productive economy, and not great actually demographics. But for the shorter time, we think that there is a lot of stimulus happening there now at the moment. So it is getting some benefit at the moment. The valuation broadly of Chinese equities has really collapsed relative to almost all other markets. So we do see, that there is interest in China for the short, medium term. It does seem to make sense considering the valuation and more of a shorter term cyclical uplift happening at the moment.
Chad, terrific to get your outlook from Talaria Capital. Thanks so much for joining us.
Right, you're welcome. Thank you. Bye-bye.
So just before I round out the global view, let's take a look at where we're going to get going at the open, which is just a couple of minutes away. SPI futures up there almost 0.5%. So looking for a positive start for the new trading week. Stay with us. The open is just around the corner.